Samantha Leduc is the founder of LaDucTrading.com. Samantha is known for timing major market inflection points in equities, commodities, bonds, rates, currencies, and especially volatility. As a macro to micro analyst, educator, and trader, Samantha makes her insights available to active traders and investors who want to minimize risk while seizing year-making opportunities. Retail institutional clients gain access to not only Samantha's unique perspective and transparent trade setups, but also to a deep trading desk of 9 handpicked and skilled client-focused contributors who are active traders and mentors. Together, they analyze and trade all asset classes and timeframes across stocks, options, futures, crypto, commodities, currencies, and bonds in support of Leduc Trading members. So Samantha, you know the drill. You have until 5 minutes before the hour. Then we'll hand away another batch of prizes for today. I'm going to mute myself now, and you have the floor.
Well, thank you very much, John and Kate. I appreciate the invite and the opportunity to explain a little bit about the story behind Leduc Trading, which is my fourth child. And basically, I have a whole team of expert analysts, educators, and traders that I bring to the front to not only offer up their analysis and trade setups, but also to support clients in live trade management. So my claim to fame, however, is much more market timing. So that's where I lead, if you will, the team and also clients in sharing all of my analysis on the market turns and twists, and not just that, but also explaining why it's happening. So this is not a trade alert service per se, although we do offer custom trade alerts and setups. It is much more focused on helping clients understand what's moving, why, and how to trade it. So a little bit, my story, I am definitely self-taught, retail rogue, and have just an absolute thirst for bridging the gap between macro and micro, which is all the complexities of what happens in the macro backdrop, and then translating it, operationalizing it for members to better make more informed decisions about their trading and investment horizon and how to manage those trades. So I am really excited about working with retail and institutional clients to identify when volatility comes in and sector rotation and all of those things that basically make me the mother of market timing, because I have been able to spy every major inflection point through the study of intermarket analysis, also through use of technical analysis, macroeconomics, intermarket analysis, quant, sentiment, fundamental. I bring it all together. So I am a solid I'm a solid generalist versus a specialist, and that has basically kind of helped me because I'm not focused on one particular silo of information. I'm really scanning and synthesizing to put together the puzzle piece that is the market. So I also really love nurturing clients through also our team of very care-centered contributors. So my thing is market timing. Not everyone will focus on that, dependent on their interest in the market and their time frame for focusing on investing and trading parameters. But I am someone who runs a live trading room, so I am in front of the market every single day, and not only spying divergences, basically through my study of the market dynamics and market structure, the direction we're going and how long it's going to take there. And then obviously this is why I have kind of come up with this theme of bringing together a whole bunch of people who can provide their particular focus on, whether it be, for example, my contributors. I've got focused contributors that commodities, oil and gas, macroeconomics, fixed income, advanced options, futures. So I'm literally providing a service through our team that provides analysis across all asset classes and timeframes. So for me personally, I'm a chase, swing, and trend trader. And that means my live trading room is very much, and for the chase time frame, those who are active in front of the computer, they really are excited about those moves. A lot of them are option traders, but swing is much more multi-week, trend is multi-month. So just to everyone has their own definition of time frame, those are mine. And my focus is anticipating volatility at inflection points. And a lot of time we don't have any, but we can have volatility in a particular sector. It's called rotation. And then in lieu of sector rotation, when money's not rotating from one sector to another, that's when we have volatility. So I'm very focused on anticipating volatility in an individual stock, sector, or index across, like I said, all asset classes. And the products that we provide are really for beginner, intermediate, and advanced level traders. So we have a Treasure Hunters Discord product, which is very much a community of younger traders. There are so many that have come in since COVID. And this is a beautiful way to kind of come in and get education. You also get my analysis, which comes through indirectly, versus Fishing Club, which is my direct product. This is the one where I engage every day in my live trading room and through a Slack client workspace where I offer up all of my analysis. But Discord's very much for the the newer traders that are coming in and they really like that sense of community. Fishing Club is much more for the intermediate trader. They've been doing this. They know my speak. They know a little bit of macro, they know a little bit of options, maybe even more than a little bit, and they want my directional feel for the market because I post that a lot, and I'll show you example of that, a whole bunch of example of that. And then the macro advisor edges for money managers, those who actually manage risk actively for their clients in the form of wealth management, family offices, and the like. And I have a former client and also hedge fund manager who heads up that product with me. So we literally have beginner, intermediate, and advanced products to help clients who are active traders and investors. And I'll show you a little bit more of that space so you can see how it all shakes out. But first, again, there's for those who don't know me, a little story, right? As I mentioned, I am self-taught, very much focused on timing directional moves, and then sharing those trades with clients. Occasionally I get asked to come on and, do an interactive broker podcast, which was on November 1st. And I said my price target was higher, 41.30 SPX, for example. We hit 40.81 so far. I've been on Bloomberg and given them my option trades, which have done extremely well. I was on CNBC Pro last week on December 1st. And guess what my number one trade was that I shared? XLE short, as well as diamonds, and basically a pullback into this week. So that's working out extremely well. So I'm very out there. Like, I'm not afraid to say, this is my market call. I either have high conviction, and clients ask me all day long about stuff, or I say I have no idea, or it's an if-then statement. So one of the statements that I had early on was featured in a Market Watch article, which was basically bonds in August of 2020 would stop going up, and that would put an end to the NASDAQ outperformance. It would also, through higher inflation and yields, cause a spike in oil. And my call at the time was in October of 2021 that we would basically double by March of 2022, and we did. We went from $65 to $130 in crude. So those are some of the highlights, if you will, of how I am looking at volatility coming into a particular asset class. For example, a trend reversal in bonds, or a spike higher in oil, etc. So my job really is to be an expert in volatility, and not from the standpoint of a quant strategy, Okay, there's a difference there. Those who are selling volatility and the rest, you've probably heard of that. That's not my thing. My thing is to time when volatility comes into an asset class to make it either directionally bullish or bearish. So that's, and I think I'm an expert in volatility, not just because I raise teenagers, but because I'm not afraid of it. And a lot of people are afraid of volatility. And I'm like, what's up with that? You can make a lot of money by anticipating the volatility. So I'm definitely the partner you want in a panic, because my job, not just as, the mother of market timing, but just kind of baseline, maybe it's the thing of being a woman, is to evaluate risk. I'm not afraid of it, but I want to always know what the risk is. Buffett had a really great quote: risk is what happens when you don't know what you're doing. So I really believe that. I also have my own quote: don't risk more than you're willing to lose. That's a really, really important one to me. But how do I identify when volatility is coming into a stock or a sector, or an index? It's really by studying sector rotation and using intermarket analysis. And I'll show you that. But I just want to let you know this is, I know, a hard way to do stuff, but this is what feeds me. I love this curiosity of the market. I have a passion for it, and I love to share it with clients. So that's my value, is basically attention to why a stock or underlying asset moves the way it does, what to trade and how to trade it. So I can go over, lots of, prior calls, which there are many, from 2018 top for a 20% drawdown to the March 2020 low, which I also was very, very good in timing this complete collapse, again, mostly because of my intermarket analysis. So I do this all day long. It doesn't matter. Gold, bonds, SPY, et cetera, et cetera. And fast forward to COVID, post-COVID, I had a very strong theme that the regime change was going to be very, very impactful on the market returns, because of my theme that we would have this paper would be replaced by things. So this 13-year outperformance in NASDAQ is basically a lot of paper. It's a lot of bond proxy. And a lot of folks don't realize that we're all bond traders now. Everything is an interest rate trade now, because the Fed has obviously finally removed transitory from its word book and hiked since November of 2021. So the whole key for me was that we were going to have rotation into from paper to things, commodities, that really, really led a lot of my sector rotation themes into the value cyclical plays, away from the growth and momentum plays. So this has been a follow-through theme, including energy, especially energy, from November of 2021. And now we're past November of 2022, and energy has been an absolute outperformer by a nautical mile. And then just recently I said, hey, slow down. I think we're going to have some profit taking into year end. It's time to protect. And that was my CNBC call last week. So I do this all the time, long story short, including, like I said, warning clients that we're going to have a double from 65.65 into 130, and we did, as well as the fact that bonds were at risk of crashing. So I did an article in October of 2021 called Deflation of Wages Ended with COVID. My whole premise was that it's a lagging indicator and that it would pick up speed, and that higher wages and higher wage demand, after decades of productivity basically outperforming wage demand, wage increases, wages actually did not increase in keeping with productivity. It was the opposite, that whole relationship would flip, and that wages would pick up speed and productivity would fall. And that was the enemy of bonds. And this was an article that I posted, not just oil as inflation hedge, but also as a bond short thesis back in October of 2021. So I've been on this for 2 years, like not a joke. And every counter trend rally in bonds or any bullish, bearish move on a swing basis in oil. They're all very, very tradable. But the point is, this worked extremely well. We had a historic bond crash, historic. Risk parity also died with COVID. And now we are right now in the midst of trading a counter trend bounce in bonds and TIP and gold and yen because of a Bank of Japan yen intervention on October 21st, which you can also find on my website, on my YouTube channel. So just to kind of break it down a little bit before I show you the Slack workspace to show you how I do my thing and then what I see coming down the pike in 2023, you can see that I really define short, intermediate, and long time frame accordingly, which is chase, swing, and trends. Basically, think of it as chases as a few days, swings as a few weeks, and trends as a few months. Now, I have a trend channel in Slack, which lists all of my recommended longs. Trends are only, in my particular channel, only longs. Swings can be very much short duration or longer duration shorts. But for my trend list, I want to share that with you. You won't find any tech in that particular list. So this is very important. I'm going to kind of go through that when I bring up my Slack channel. But I'm not just focusing on trends. I'm not just focusing on swings. Like I said, I serve many masters. So I work backwards though. In other words, from the big picture, I like to swim with the current then against it. Many people were chasing GameStop, but I had this positioned in July of 2020 on my $4 to $40 list for clients. This is a client made out very, very well. Long before this thing hit 240 and then, doubled in a freak of nature kind of thing in January of 2021. But the point is, so I'm on multiple time frames, but we are weaving in and out. Okay, chase, swing, trend, just to kind of keep it in your mind of how we are, how I differentiate. So basically, my big idea trend trading, which is something I wanted to share with you, and then kind of show you what myself and the contributors are doing in Slack, and then share my 2023 themes, because I think we have one more leg down in tech. It's not done yet. And I want to show you how I come to that conclusion. Okay, so first, just so you know, all my stuff is discretionary trading. This is what I do. So just to kind of let you know, these are, this backdrop, as I mentioned for folks, is very much I'm putting forth my stuff, all my contributors are, and they're deciding what they want to pick and how they want to trade it based on their own risk parameters, their own experience with options, their own attention to the screen. So basically, everyone picks their own time frame, right? And they're in their preferred vehicle. But this is definitely, let me just get out of this one. My theme for 2022, revisited. So for anyone who might know me and might be in this webinar, you will know well that at the beginning of the year, okay, for clients, it started in November, December. But publicly, I was asked on a Stock Charts TV interview, and then I posted all of my thoughts regarding why I saw growth to value rotation continuing. Because remember, energy was a huge outperformer in 2021. And I was a really big bull in 2022 for energy. And this, again, was all about my mantra of things over paper. Inflation is sticky. Oil as an inflation hedge. Deflation of wages ended with COVID, etc. So nothing changed. And now a lot of folks are saying, has this changed for 2023? And I would say, not much, but I'll go into that a little bit more in a little bit. So stagflation as a concern. Remember, this was all printed in that December, January timeframe. We had supply chain issues, inflation expectations. We still got very sticky inflation. We're probably going to have a 7.4% print in CPI next week. It's not over. Anyway, the point is I had gone through and put all of my reasoning for why I saw a continued rotation from basically those momentum growth tech names into the, lack of a better word, anti-momentum, low beta, value cyclical names. And I, put my thing out there and basically said, by the way, also volatility. Guess what? We will have Fed-induced volatility because they're going to be changing their tune. So we have not had any big volatility spikes this year, except for one, really, but it still wasn't even of size relative to like the COVID crash. But we've had incredible volatility intraday this year, so much so that it is the biggest year of volatility since 1950. So we've had a lot of big intraday swings, and everyone who was caught in the CPI bear trap knows, right, of that standard deviation move, 4.5%, 4.5 standard deviation move on November 10th, which triggered a short covering rally. Yeah, that kind of thing. So the point is that we have a lot still, in my humble opinion, of this rollover still in play. So this is a chart that I had put. It's an intermarket analysis between growth and value, and it basically showed that we had a rollover in this August-September timeframe of 2020. We had another one coming in, which basically was this November 2021 before, right, the January fall. That in other words, the market started really dropping in earnest beginning of the year. Well, my prediction was that we would have a 20% drawdown. So at the time when I made this, it was 4,800. My prediction was that we would fall 20% to 3,800. No one else on this panel of 5 that were very renowned money managers, Bloomberg economists, no one else had that. But I felt very convinced from my intermarket that we had more to go. And basically, an accommodative Fed reduces volatility. A tightening Fed, by definition, triggers it. With that, value should lose less than growth at the very least, if not straight out outperform. Now, let's just see. How did we do? For example, this is my Slack workspace. How did we do? Extremely well. So this is an ETF total return in the 2 years. And by the way, this is how long I've been running this trend list of mine, where energy outperformed by a nautical mile. Okay. And this is just to kind of show you the trend update that I keep. On Friday, December 2nd, okay, I'm a big energy bull, big picture, structurally speaking. I'm also a big dollar bull, but that's not to say we don't have pullbacks, which I warn clients about. So this was basically my thing. After crude oil gets or stays above 95 bucks, I definitely warned folks early on that if we broke, we were going to head down to potentially 75, 77 area. We already did. We bounced and now we're breaking below that into 65, 65, which we're getting really close to, which is monthly support. China is still a demand, destruction entity for oil as far as the lockdowns and as far as even manufacturing demand, 40% just came out this week. The point is we have definitely an inflation trigger for higher oil, but right now it is very suppressed. So my point was, I am seeing very strongly that equity space is extended and tired. Refiners have rolled over, and end of year profit taking in the sector looks close at hand. I removed some very profitable plays and then replaced them. I put all my annotated charts, all that good stuff. And I am going to show you that chart. Here it is. Minus the tickers, because that's only for members. But this is something that I provide for clients and review it every week. And then if a stop is getting close at hand, like on this particular day on 12/2, you can see that I added a aerospace and defense play, another consumer defensive play, an electronic components play, and an industrial play. Those were 4 that were added. I removed some profitable plays. They were just, I'm expecting some pullback here, so I wanted to lighten up. But you can see the returns. This is slight negative. These were positive. There's a negative. There's a very, very big positive, a nice positive, a really nice positive. These are all the energy plays. And I said protect or remove. And this is how I communicate that trend list to clients. But why I'm kind of pointing this out is you won't see any tech. So Michael sorted this by sector, so you can see lots and lots of value plays. You can also see lots and lots of gains, Weekly close above is basically a stop so that clients can manage their own risk. The point is we got a lot of consumer cyclical and defense and staples and energy. Oh my God, energy's just been phenomenal. Some healthcare, a little bit of biotech, but I don't have any tech in there. I don't have any semiconductors in there. And why? Because I think we got one more leg down that's going to be a doozy. So if that was my 2022 prediction, which is basically 20% down, I reviewed it because a year ago in November, I had basically started putting together that thesis and I was waiting for the top in order to call it a top and then a rollover. And we got it, right? And I saw it in advance and I warned clients in advance. So now fast forward and I presented my thesis to clients and said, hey, when is it safe to buy tech again? It's still not. We got one more leg down in my humble opinion. So here's what to look for. So this particular, article I just obviously gave to clients, but it still applies. It's going to be a 2023 prediction. So just kind of keep in mind, there's a lot of macro involved in my thinking as it relates to, okay, is the Fed going to pivot? What's the Fed pivot put? Is the recession going to trigger? If so, when? Because the market is basically expecting the Fed to cut in 2023 and normalize in 2024. And if the Fed comes out next week and says, no, not really, then the market will be disappointed. But if the Fed comes out and says, yeah, that's our plan, then the market will be happy. So the point is, I do a lot of work around reading the macro tea leaves and then writing about it. So the point is, we're not at a bottom, especially as it relates to NASDAQ. And I have been right about this so far. I'm pretty confident and high conviction in this call for next year. All of this stuff I've written about before, but the point is, I did an article also in January, which was, we had a lot of growth sectors top back in February 2021, and they need a lot of time to bottom now. Yes, eager buyers may show up to buy what's on sale, but they aren't picking a bottom. They are trying to make it. Let them. So January was the start of the pullback. Everybody wants to buy. Everybody always wants to buy. But when is it safe to buy? That's my job. So it's not safe. Okay, continue. Okay, we had all kinds of, drama in the mid-cap tech space. It was beautiful because we had a number of these actively short, and also some consumer plays like Starbucks and Nike and Disney. Those were my highest conviction. Dow shorts, or I should say, consumer kind of spending picture that would be really, and XHB, they all worked. Lots and lots of meat that was harvested in regards to the mid-tech and ARC and all the rest. But the point is, here is the chart that says it's not done, even though they are very oversold, relatively speaking. They have not really given up any more. They've just digested since summer. But this chart is very different. This is one of my charts that says, wait a minute. Here's that top we had in 2020. Here's that top we had in 2021, right? Remember this? I showed this. That happens to be the picture I grabbed was January 2022. Here's where we are now. We got a third one coming. Brace for impact. So since this 11/16, we obviously had a nice run post CPI, last CPI, which surprised to the downside. But the point is, this doesn't change on a dime. We're still at risk. We're still at risk of having the momentum stocks fall more. The last general standing, Apple, fall more. Tesla has been a phenomenal short, fall more. The point is, this is not done. And there you go. Thank you. That's what I call the third wave. So all of those things that folks are so excited about, and I don't mean the Chinese the ADRs, the K-Web contingency, that's bouncing on a whole nother reason. That's very much because China told their state banks a few weeks ago to stem selling in stocks and buy them. So that has been ripping higher. Stocks, bonds, yen, gold have been ripping higher because of Bank of Japan intervention on October 21st. I mean, it's really been a short covering squeeze for the record books. This is something I wrote for clients on November 11th, right? So even on the intra directional moves, I am very, very focused on what's going on with market structure, CTA buying, and the rest. But my NASDAQ underperformance call is still in play. Okay, that's really all there's to say about that. I started off with this particular chart back in November. That's not blowing up for me. This is where we were in November. Bounce or trounce. We actually, there it is. Thank you very much. We actually had a pretty strong bounce, as you know, in the markets, but not so much in NASDAQ. So this is very much my feel that this particular very large, okay, this is the bounce we had. We can't tell because you can't see it's on a monthly. This very large head and shoulders that I called out back in November, December of last year has followed through. We've had a little bounce. The next leg is lower from that technical look. And mega caps really matter, right? This Fangman market cap is a percentage of S&B and how beta correlated Apple is with SPY and all that jazz. But tech is really a rates play. And right now we've had a nice pullback in the dollar and yields. And also VIX has stayed suppressed up until Monday, Tuesday, which I also mentioned to clients as a warning because we got onto a very, very key level for a wee bounce in all three. But the point is that we still have a very strong argument for this correction period in dollar yields and oil before they move higher next year. And that's where it's going to hit tech the hardest. GDP matters. I talk about recession, all this stuff, but let me get to the unemployment. I talk about that. I don't want to, spend all this time on the macro or earnings. But the point is I have a lot that I give for clients to help them understand my views about how the macro will impact the micro, yield curve inversions, the whole thing. I also am very, very blessed that Craig Shapiro, who heads our Macro Advisor Edge product, is absolutely beyond fixed income savvy. As I mentioned, former client for years, hedge fund manager, so he can translate a lot of what's happening in that world as well. So a Fed pivot isn't going to fix it. I do a lot of analysis also with my intermarket to kind of support my claims, right? My macro claims. Fed is just trapped. They might try to pivot this year, but it's not going to work out so well. Anyway, so I always provide the spoken commentary, live trading room, custom engagement, but then I also write it up, post it either as a newsletter or in Slack. So that's the benefit, obviously, of the Fishing Club membership, FYI, which suffice it to say, we have a lot of risk that is macro. And then I get right into the weeds of NASDAQ is in a major bear market, even though you don't see it yet. Big claim. And I believe it will continue to underperform just like we had in 2000 and 2008. And here we are. So unless and until this indicator, among other tools that I use, gets back above in quote unquote safety mode, it's not safe. So this is just some of the stuff that I share with clients from an intermarket standpoint. That's big picture. Now let me show you what I got on the smaller time frame. All right. All right, so here's a little bit of gobbledygook for some, but it is my secret sauce, okay? So what I do is I prepare analysis across lots of assets. So this is, the dollar. We're going to come back down to this 104 area. We still need to wait for it to finish going down base and reverse higher. I write my analysis and post my pretty pictures. Like we could even have an overshot to this 102 area in the dollar. And why does that matter? Because the dollar makes the weather. And it absolutely impacts the market direction. So when this gets back down, okay, now maybe it gets supported at this, 103.65 that I gave, or maybe it needs a different perspective, which is this trend line from the summer. But the point is, only then must it base, turn higher, and follow through to be risk off with confirmation. In other words, more than just a few days, right? So this is kind of an intermarket channel. I also provide, for example, this kind of thing. We're almost there. So this is NASDAQ McClellan summation. It's an intermarket tell that I help clients with. So when was it safe to go long? Right here. You can see this crossover was really nice, right across the board. And we have been moving higher, and now we're starting to intonate that crossover, right? So this is now where you lighten up, but quick, those swing longs, and you position or prepare to go short. So this is the type of intermarket that helps me with my trend trading, okay? And very much so for clients that are interested in kind of the secret sauce. My macro to micro channel within Slack is a little bit different. It is something where I can, come up and talk about, for example, this thesis that I have that's more macro to support. So what I showed you with that QQQ chart with rate of change in the bottom panel that shows we had massive bear market in 2008 and 2000. Well, this is my macro channel that shows why. So for example, there's a stock bond ratio, and it shows that there's more room to fall, and stocks aren't cheap enough. And typically equities don't bottom until they are cheaper than bonds. And because we've had this historic crash in bonds, despite the equity pullback, stocks are still more expensive than bonds and credit. And I go on and talk about a Fed policy mistake that's growing in sticky inflation. And basically, again, the warning that's coming up for FOMC, right? So market is pricing in a pivot. And I talk about this. If we are right now pricing in a Fed rate cut in 2023 and lower rates in 2024 so that we normalize, the market will continue to go higher if the Fed says so. But if the Fed comes out and says, nope, we're really staying higher for longer, we're moving the terminal rate even higher, the market's going to say, wait a minute, what happened to our pivot? What happened to our pivot put? And I believe very strongly that the market will give up the ghost as it relates to this push higher into my 41.30, which was my price target that I gave clients, right? Beginning right after the BOJ yen intervention. And we will go right back to and below 3,800. So this is the type of thing that I write here. And then in in my Samantha market thoughts, I will further detail. Like I closed my trading room at 11 o'clock this morning, and you can actually see what I wrote here. Oh, let's see. I got a whole bunch of stuff. All right. So I talked about my CNBC Pro segment, which is a news show I was asked to be on, and my calls for higher TLT, as well as tips. I'll show you that. My favorite diamond short plays, and write down my XLE rollover. So all of these things I have basically talked about last week, and then I was just updating them over the weekend. There's my interview. And then this morning, or 7 hours ago, pre-market, I wrote, is the stock and bond bounce over? This, again, all of my analysis, charts to support it, my macro thesis, et cetera, et cetera. And then I get right into the weeds, right? So here are the levels that we need. Otherwise, bears can unwind this entire CPI gap up from November 10th, and we can see SPX 3,800. Right now, it's not my baseline bet. But the point is, we have a lot of risk going into FOMC. Clients also have some access to some special indicators that I use. But for example, just on a chase thing, right? What really matters now, today, and I turned my charting software off, so I don't even know what the market's doing. But I posted, here's where puts can monetize. Literally, this 39.31. Oops. Puts can monetize, put a bid in the S&P, and obviously shorts would cover. Those puts are basically short duration. We have a lot of gamma chasing going on in individual stocks and sectors. So if they were to cover, we're going to get a bounce, right? So we're hitting my price target intraday. is this where we get a follow through to the downside, in which case, beautiful, we're going to get to 3,800 sooner rather than later. Otherwise, we could turn this and move higher, stabilize on Wednesday and move higher into end of week. So my point is, I'm giving levels, hour, day, week, for those who are chase, swing, and trend trading. Hopefully that makes sense. And I'm not the only one that's providing, support. So Archna, I'm going to just go in alphabetical order by my contributors. Okay. So Archna is a live trading room moderator, and she posts her advanced option tactics. Okay. And clients get a benefit of doing following or not. But the point is, she's also in my a live trading moderator. So she provides custom trade engagement for clients. I'm not, able to do that for everybody. Bob is is basically a second generation oil trader. So he advises clients who trade the physical. This is a gamma flow channel. So those who are interested in gamma flip levels and what particular sectors have gamma positive, gamma negative activity for option traders. Jordy is a full-time commodity trader. Craig is just a phenomenal, like I said, hedge fund manager and macro advisor. Michael is my live trading moderator, and he also does a lot of support for customers. Pat is very, very focused on select option flow to help clients identify unusual option activity. Rithika is also a live trading room moderator, and she is an Elliott wave expert. So she posts her trades and her charts as it relates to, momentum. So she's short duration. Sudha is futures, right? So you can see that we have an active kind of presence in regards to Zoom, in regards to Slack. I didn't mean to cancel that off, as well as very active trade support and very successful lists like the ones that I just showed you in regards to trends that are, by the way, I've done this for 2 years now. So some of these trades, I will tell you, BTU, which is a coal play, has been in here since $5.22. It's doing phenomenally well. And there are clients who then take that trade and will, when it starts to digest, right, they will sell calls against it, buy puts to basically trade around a core position. And I will let people know when it's time to protect, like I did last week. Careful, protect these gains. We ended up taking some of them off the board because I really feel that XLE is going to be a little bit more eventful. Oh, I forgot to show you. Swing. These are plays that I have recommended. So for example, this is actually, Robert had recommended, this was a great tell for refiners to roll over. And sure enough, it did. I mean, they're a good $20 lower now in these oil crack products. And this helped support the short-term refiner trade lower. I have been excited about this newish short, which was also the one that I recommended on CNBC. We're now down here, right? And it only took a few days. But the point is, once they go, they go very quickly. Goldman also, actually that's Costco. Costco was a recommended swing short, a beautiful bull trap that has continued lower. Goldman was also a recent, this is Nat Gas, been on top of that. Here's a Goldman, new short, triggered and beautiful. I don't know if you've noticed it today, but we did gap fill pretty much this morning. So this is how clients use our Slack client workspace. These are mine, Chase, Swing and Trend. I talk about global sector rotations, and I only offer up the crypto space for Bitcoin and Ethereum because I'm not a crypto trader, but I let them know where I see it going, basically. This is definitely not my preferred vehicle, but a lot of people are excited about it. All right, so you've seen a little bit of how I can communicate this to clients. And here's one that I may or may not be doing anything with, but for sector rotation, a new one, we'll see, pot stocks as a bottom fishing sector for 2023. Yesterday in a sea of red, the only sector that was green was cannabis. And there's a reason why. because there's some legislation coming in that would create a framework for the cannabis industry to access financial services, and they need that. So this has been an extremely depressed sector. Maybe this will be a really nice one for 2023, but I'm not going to touch it until end of December. All right, so that is a little bit how this is organized. I definitely invite you to, check out LaDucTrading. I got a free bait kind of thing. I have a Twitter profile at Samantha Leduc. Feel free to follow. We also have a YouTube channel where not just myself, but also Rithika posts her weekly watch lists. Michael has his coming up as well, which is more educational. My theme for 2023 is be careful. I think the bond move right now is going to, as I mentioned, for clients, hold on, let me just get to this. Okay. Michael helps me, and then I'm trying to search for a particular chart. So for example, this, I had recommended tips and bonds, and there were particular reasons why, of course, but we had this beautiful follow through in the this was TIP, for example. After 2 months of consolidation, we're already up to 110 and pushing to 112. The dollar yen rolling over. So yes, I also do currency, coming back down to 132. Dollar yuan is also forming a very imposing head and shoulders. Recommended on 1021 live, the yen via the form of FXY, which is a retail friendly trading vehicle to trade the Japanese yen. It's doing phenomenally well, including gold. So they were basically basket trades that are all correlated, because that's what's been going on in 2022, where if the Bank of Japan is defending, right, its bonds, then the result is the dollar will come down, yen goes up, and when yen goes up, dollar goes down. It's providing this, tailwind for stocks, for bonds, for gold, for yen. And so basically you can see I have a lot of detail for clients, and this is why I'm really excited that you can come in and kind of see all this and then explain your questions to me in my live trading room, where I can kind of go through and explain what I see. And then if you have any questions that are suited for my contributors, you do that. It's very, very easy to join. And I would say we're a very caring community. This is just someone that I think has assembled a hand-picked crew of very client dedicated contributors. So you get my analysis, but you also get theirs and trade setups and a lot of custom trade engagement. So this is basically what I wanted to kind of share with you today. If you have interest, this has basically a limited time on it. I don't do these very often. You will know it, because if you follow me on Twitter, this is like once or twice a year, period. I'm way busy, as you can see, posting for clients, engaging with clients. So my thing is clients. So this is an opportunity that if you want to grab it, it's a great offer. There's some ways to get a hold of me. Okay. And there's the offer. If you have any questions, just hit me up. Let's see. Where am I? Oh, prizes. Yes. Slides not updating. Not sure about that, but pretty sure that John has the prizes. There are 5 weekly passes that'll be given out. They're $125 value. Normally, the Fishing Club membership is $350 a month. And this is obviously greatly reduced so that you can kind of catch all my analysis, come into live trading room, or not. You can just stay on Slack if you want. And you can also engage with the other contributors as well as members and figure out what is important to you. And we'll definitely support you. If you have, let's see. Yeah. Okay. And if you are interested in Discord, this does not apply. I'm afraid it is not relevant, but you got a free 7-day if you want to go pop in there to Discord and check it out. You just don't get, you don't get me actively. So active is the fishing club membership. So Discord doesn't apply for this offer. I'm sorry. Yes, I have a number of women on the team. I am excited to be voice of women. I want very much to encourage more women in trading and finance. I think we're extremely, good with our nurturing, but also our instincts. And this hard work ethic for sure is all manifest in my day-to-day in delivering the analysis and the custom engagement for clients. So very happy to include more women in my contributor list in the future. So I love having strong analysts, period, but I'm especially excited about the results and about their customer care. So for me, I happen to be the lead, but they are operating and creating community every single day, and I love it. It's very exciting to see. I am not a Santa Rally devotee, as I just mentioned. I think my call was actually 41.30 would be the price target that I could see before a rollover. I do see some liquidity concerns into the end of the year, and I would be actually more inclined. My expectation was that we would hit 41.30 and then pull back and close below 3,800 by the end of the year. And I hate making end of year predictions, really, I do. But that was my call beginning of November. I was very bullish stocks and bonds on October 21st. I have a YouTube video, you can find it, Bank of Japan, yen intervention, very, very bullish stocks and bonds into the 41.30. We may not get there. 40.81 might be it. But for right now, that's my baseline bet, not higher. I think we will pull back. And again, the FOMC has some risk to risk assets if they do not offer, in essence, forward guidance. Just like a corporate return, a corporate earnings call, right? If they offer a week forward guidance, what happens to their stock? Market reacts and punishes them. So we'll see what happens with CPI. I think it's going to be a little sticky. 7.4 area, and then I think we're going to have some risk occurring at that FOMC, and they'll typically front run it. So right now, the most important level for me is 39.31. Do we bounce there? Puts get monetized and we head higher, or we lose it, and if we lose it, we're going to head down to 3,800 sooner rather than later. Well, yes and no. So Jay Powell suggested 50 basis points, and yet we're 100 basis points from the terminal rate. So we basically have a 50 basis point hike expected, but literally we've got a 4.85% that has not yet been priced in. So that's kind of why I mentioned this launch pad for disappointment, because the market is pricing in a cut in 2023 and lower rates in 2024. So if the FOMC comes out and says no, and remember, they're using a lot of lagging data. So they're waiting for unemployment to spike higher, job openings to spike lower. And this is definitely the risk we have going into end of year. But CPI is December 13th, and the FOMC minutes are released on Wednesday, December 14th at 2 o'clock. Powell gets to the podium at 2:30. I usually run my live trading room on that day. So we'll see what the market has in store. Right now, VIX is definitely trying to come up off the bottom. Staying above 19 would be negative for risk assets, and breaking that level would be very bullish. Yeah, dollar yield, this is a Bank of Japan intervention was the reason for the season in the pullback in the dollar and the yields, as well as VIX. So now all three of those are trying to find their bottom, but they still have to follow through. So just keep that in mind. We still have some time to go here before we can get assurances that the dollar is done going down And yields, if they get back above 3.67, then we'll have another two-way market for sure. So that's what I wrote over here, basically, which is, yeah, we could have I still think potential of 103 and 65. I got very specific levels for client, but the point is we need to get back above 3.67 on the 10-year. And be careful what you ask for, because market is rallying on a Fed pause or pivot. But every time that we've gotten to a pause and then a pivot, a pause and then a pivot, a pause and then a pivot, guess what's happened? The market is tanked. So there's a rule of thumb. You don't buy the first pivot, you buy the last. In other words, you don't buy the first rate cut, you buy the last. So we have a long way to go in weaker markets, in my opinion. We are definitely not pricing in recession risk, but we're also not pricing in higher for longer. So one of those two is wrong. Hey, I want to thank you very much for just, curiosity, seeing what I've got to say. I am definitely someone who has some three modes of operation when it comes to analysis. High conviction. I don't know if then. So for me, I have, very technical levels that I'm watching in a number of sectors and stocks. And for me, I want to see what happens when they get there. I want to see literally if we get some follow through. It's a little bit too early for this particular, yield pullback. I'm still very bullish yields next year. And that's, by the way, a big hit to the yield, to the tech proxies, to tech and to bonds. So, but I'm patient. I've got some levels. I'm waiting for them to move back higher. And that's kind of the reason for the 2023 predictions. NASDAQ is still in some pain. Long story short,